Hello everybody. For those of you who have seen some of my more recent videos, many of them appear very bearish on the surface, and for that reason I've received some criticism that I'm some sort of a perma-bear or a very pessimistic person. And that really couldn't be further from the truth. I really am very optimistic in the long term, but I don't think the majority of investors understand the real hurdles that the economy is facing in the coming years. And if you are reading or watching, only the Wall Street mainstream media or any of the mainstream media in general, you would have the perception that we are at the beginning of another secular bull market or at least another cyclical bull market. You really can't go anywhere right now without hearing about the soaring commodity prices and pent-up demand and how this all equates to a booming economy. But in reality, the real situation of the economy of all major countries is much more bleak. So in this video, I will discuss the real disconnect between the stock market and the economy right now, why it is so extreme, and why the current spending spree and pent-up demand we're seeing can't last, so stay tuned. Hello everybody, welcome back to The Contrarian. For those of you who are new here, my name is Logan. I really like to talk about overall success investing, the markets, and alternative views based on facts and fundamentals, and this sometimes does align with what the majority of people are doing, but it rarely does. So if you like these kinds of topics, just consider subscribing. And also, I'll make a disclaimer that this isn't to be taken as financial advice. But to start out, we are really seeing an enormous disconnect between the stock market and the real economy right now. Stock prices reflect a massive continued consumer spending as well as continuing cheap rates at which money can be borrowed by companies. And as you will see later on, both of these are faulty assumptions. But let's just look at some of the most extreme examples of pent-up demand that is causing asset prices to go up right now. Most notably, Jamie Dimon, the CEO of JPMorgan Chase, recently released statements that sum up the thoughts of most of the Wall Street elites right now. I have little doubt that with excess savings, new stimulus savings, huge deficit spending, more QE, a new potential infrastructure bill, a successful vaccine, and euphoria around the end of the pandemic, the US economy will likely boom. This boom could easily run into 2023 because all the spending could extend well into 2023. And later on, he called stock market valuations quite high and said that a multi-year boom may justify current levels because markets are pricing in economic growth and excess savings that make their way into equities. So regarding these quotes and the current as well as coming euphoria, I believe Dimon is correct. He does know that asset prices are at least in part being boosted on euphoria, but I really think he is ignoring some very crucial pieces of data. So to begin with, the idea that the stimulus spending will last until 2023 is quite simply not accurate. We have not seen people, they've either saved their stimulus or they've just gone out and spent it very quickly. In previous rounds of stimulus, it was spent just in a matter of months. So the idea that it lasts 2 years from now, I just don't get how that would happen unless he thinks it's some sort of consistent UBI, universal basic income, that continues. But if anything, that would put even more debt on our already nearly 30 trillion of total debt. And that is what Jamie is fundamentally ignoring, is the effect that debt has on an economy. And sure, if rates continue to stay this low or even lower, debt could be increased without much of a problem, without much expenditure on servicing that debt. But as we have seen in the last 3 to 4 months, rates are anything but controllable by the Fed. And a quick explanation of why this occurred, of this rise in rates in the last 3 to 4 months, is of how the bond market works. Quite simply, bonds are debt. As demand for bonds goes up, rates move down as more and more lenders are willing to earn less of a return on the money that they have lent out. But as demand for bonds fall, rates rise as lenders want a higher and higher rate of their money that they have lent out. And this is what has occurred recently. Rates have risen as investors are simply not willing to pay, for the rates of what was then a 1% yielding 10-year when inflation is already running at 2% supposedly. And that, if inflation is actually only 2%, that's a negative real rate of return of 1%. And if anything, real inflation is running much higher than the reported 2 to 3% target of the Federal Reserve. So where the cat really gets out of the bag on the entire economy and the situation surrounding the debt right now is when rates begin to rise, and right now they aren't rising, they're beginning to correct back lower, which the stock market is loving, and which is in part driving this melt up in equity prices that we are seeing right now. But ultimately this cannot last. Rates will continue to go higher eventually if yield curve, and even if yield curve control is tried, that would only be a very temporary pause, in my opinion, on the increase in rates. And if anything, yield curve control would have the potential to make rates rise even faster as investors finally see that the Fed is beginning to panic. So in the long term, 6 months or more, it is highly likely that rates continue to go higher after they consolidate, and that would occur when equity prices are at all-time highs. And in my opinion, and the opinion of many other notable investors, fund managers, and strategists, you don't have to look very far. It is probably coming to an end more quickly than 2 years from now, at which point the cat really gets out of the bag and the Fed can't control the rates anymore. So I'm making this as an honest representation of what I have heard from major market voices who I give the most credibility to. And, I don't give much credibility to guys like Dave Ramsey or Jim Cramer or Jamie Dimon, who I was just talking about, or any of these Wall Street elite, just because they have never seen any of these problems coming before they occurred. You look at past problems like the dot-com crisis. How obvious is it that all of these vaporware tech companies aren't actually worth billions of dollars? Or how obvious is it that subprime mortgages are in a bubble? You would think that they might have seen these coming before they happened, but they did not. And if anything, that took them completely by surprise. And bottom line, they are just part of the corporate machine that Wall Street is. They don't see the real world as it actually is. They don't see rural America or rural Europe, where and just how devastated people have been who were barely making it before COVID and now have been completely crushed as a result of the COVID shutdowns. And all they see is that consumer spending is temporarily surging due to stimulus. They see the other wealthy people who have grown extremely wealthy adding trillions in cumulative wealth as asset prices have skyrocketed. So in other words, I really am not surprised that people who live and breathe on Wall Street can't see these crises coming, because there really is nothing in their lives that indicates anything is wrong. So this video is not meant to be some sort of a doomsday prediction. It is just my honest explanation of what I have seen and heard from many other people, and what will likely continue in the coming months and years. We'll likely see retail traders, continue to pump these worthless stocks or SPACs or cryptos a little longer, and at some point there will be no more dumb money to buy up these bubble assets and they will collapse. And if anything, there are some really telling signs out there right now that this collapse could be coming quite soon. For example, insiders are selling like crazy right now. In fact, looking at this chart, insiders have never, in the past 7 years, they are at all-time highs of ratios of selling to buying. So yeah, if you look at the time when they were the most bearish, it was back in December, beginning of 2017, and then right before the COVID shutdowns, they were also very bearish, and then they, of course, bought the dip as soon as the Fed said that they would backstop everything. But now look at the sell-to-buy ratio, it's up at around 4.5. They are really selling right now. They bought at the bottom in March of 2020 when they realized the Fed would pump trillions more into asset prices, but they are selling like crazy as the stock market continues to march into this melt-up. So the only real reason why asset prices continue to go up rather than down due to this high degree of selling from the insiders on Wall Street is that the inflow is coming from other people who are caught up in the euphoria of it all. And right now, with all the stimulus and unemployment benefits, that is very likely the people who are receiving ongoing stimulus payments who don't really need it and who are now speculating with it. So in a way, this whole melt-up that is going on makes sense. The higher and faster market prices move, the more euphoric the crowd becomes, until everybody who possibly can be investing is investing, and at that point the market has reached a blow-off top. So in a way, Jamie Dimon is correct in that he sees a continued inflow into assets due to euphoria, but unlike him, I do not think it will go into 2023, and I definitely don't think this is the beginning of a new bull market. So that's my contrarian take on everything right now. What you decide to do is completely in your hands, but I just want you to be aware of how unusual and volatile of a time this is shaping out to be. So with all that being said, I hope you enjoyed this video, and I hope to see you again.